Hello traders, this is favoured dollar market analyst for City Index. Today is the 9th of July 2024. So the markets remain quite contained inside a narrow range ahead of the Fed Chair Powell's testimony, and more to the point ahead of the US CPI on Thursday. And as you can see by the chart of the euro dollar, for example, rates haven't moved much in the last couple of days after rallying last week on the back of what was a bad week for US data, with nearly all of the major economic pointers, the ISM services, manufacturing PMI, ADP, you name it, all of those came in weaker than expected. Even the jobs report was weaker than expected when you take into account the revisions to the prior month's data. Anyway, that caused the euro dollar to rally, and this pair was additionally supported last week by expectations that the far right party would be kept out of power, which proved to be the case, and that's why we haven't seen any major reaction in the euro dollar at the start of this week. But as you can see, it is now testing this area of resistance, these trend lines that I've drawn, one from the high of July last year and one from December of last year. The euro dollar is now testing the area around those trend lines, and it needs to really break out to provide a clear bullish signal. So resistance come in as I zoom in at around 108.40 to 108.65 area, the shaded region. Can we see a break above this area this week on the outcome of the CPI? That remains to be seen. So we do need to see US CPI come in at least in line with expectations, if not weaker, to boost the odds of a Fed rate cut in September further. On the downside, support comes in at around this 200-day moving average of 107.90-ish to 108 area. Below that, we don't have anything significant until 107.45. And then thereafter, you have the support trend of this converging trend lines coming in at around 107 area. So while rates remain inside these converging trend lines, there will be no clear directional bias on the euro dollar. But you can see that with the recent higher lows and the fact that prices moved above the 200-day, for example, this has caused a bit of a bullish development, if you like. Now on the weekly chart, you can see that the cable has broken its bear trend that had been in place since June of 2021. A very long-term bearish trend indeed. And the fact that we closed last week solidly in the black, printing this thrust candle following several weeks of indecisive price action, this is clearly a bullish sign, and which indicates that the cable might be able to stage a breakout above at least the March high of 128.93, but potentially it could get up to the July 2023 high as well at 131.42 or thereabouts. In terms of support, 127 is now the key area to watch, with the backside of the trend line also converging around those areas. But the key level or the line in the sand for me is at 126.15, which was last week's low. Any move below that level would completely invalidate this bullish technical picture. So from a bearish point of view, you would want to see a move back below 126.15 to trigger a fresh bearish signal, while the bulls would be happy if we see a small pullback, but ideally some upside follow through now. It's worth keeping an eye on silver because it has broken out of its bullish flag pattern to the upside, reestablishing its bullish trend line. Could we see a similar rally that we saw back in early May when it broke out of a similar pattern to the upside? Well, that could be a possibility should we break 3150 resistance, which was tested last week following a massive 7% rally. So a potential break above that level could trigger fresh buying towards the May high at 32.51, but potentially silver could go a lot higher than that, depending on how the US dollar reacts this week. In terms of support, key support is this shaded area around the $30 zone, where we have the 21-day exponential moving average also coming into play. Slightly above it, we have 30.55 area, this blue line, which was tested earlier this week, and we bounced from there. But we could potentially see another retest of that level, given that we don't have any major economic news until Thursday's release of CPI. Now then, crude oil prices have pulled back quite noticeably from resistance at around 84. Here we have the 78.6% Fibonacci retracement level working along with prior support and resistance area to provide stiff resistance there. The crude oil price has now fallen to test the broken area of resistance or prior resistance at around 81.50, or thereabouts, where we also have the 21-day exponential moving average coming into play, the shaded region basically. So it's possible we may see a bounce back from here to push us back towards that 84 level once again. But we do need to see a bullish reversal candle here, because this is the first time in weeks that we've seen a 3-day sell-off. So if we get a positive close today, or potentially a bullish reversal candle tomorrow, then that could be the bullish signal that I would be looking for. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.